Hello everyone. In our previous video, we have discussed in detail about the profitability statement. What are different profitability terms: gross profit, operating profit, EBIT, EBITDA, net profit, and we have discussed in detail about what are those terms, how to analyze, interpret it, and what are the things you need to consider by analyzing. Yeah. In this video, we are going to discuss about another important term, that is EPS. EPS. Okay, we'll see what is EPS, how do we calculate it, how do we analyze it, what are the things we need to consider by analyzing, and what are the limitations for this, right? So let's begin. So what is EPS? EPS is basically earning per share. Okay, if I say in simple term, so what does it tell? How much profit company is earning, how much profit company is earning for one share. On one share, how much profit the company is earning. That's what this EPS says. Okay, on one share, how much profit the company is earning. Okay, now what's the formula to calculate EPS? So basically, if you see, there are two elements. One is share and one is profit. Okay, so if I write down in a very simple way, so it is profit per share. Okay, so it's profit per share, so profit divided by shares. Now when we say profit, what do we mean? Okay, here when we are talking about shares, we are talking about the equity shares. Okay, so what do we mean by this profit? What kind of profit it is? So since we are talking about the equity share, so this profit means profit available for equity shareholder, or earning available for equity shareholder, available for equity shareholders. Okay, divided by shares. Now share, what do we mean? It's the equity share, so it means number of equity share issued. Okay, earnings available for equity shareholder divided by number of equity share issued. Now what is earning available for equity shareholders? So we have seen in our previous videos, like when we prepared the P&L statement and all, the last item mostly it is PAT or net profit or net income. So PAT is after, from the revenue, if you deduct all the expenses, operating, direct, indirect, everything, then you will get your PAT. So PAT is generally which is available for shareholders. Okay, but if the company has any preference share, if there are the preference shares in the balance sheet of the company, then from PAT or net profit, first preference dividend is deducted. So you will deduct preference dividend because that has to be given to the preference shareholders, and once the preference dividend is deducted, that's where you get earnings available for equity shareholder. So from the PAT you deduct the preference dividend, and whatever is remaining, that is the profits or earnings available for equity shareholders. So that will be that figure, and from there, from that you will divide number of equity share issued and then you will get EPS. Another thing is like number of equity share issued. So if you are analyzing towards the end of the year or towards the end of the quarter, so whatever the number of equity share, you will take that. But there are some cases where, like at the beginning of the year, company had like 1,000 equity shares. During the year they have issued more equity shares. Let's say they have issued 200. So towards the end of the year it became 1,200. Okay, so in that case what we have to do, we cannot just take this 1,200 directly. We need to take the weighted average number of shares. Weighted average number of shares. Now, how to calculate that weighted average number of shares and all? So all these things we are going to discuss in our upcoming video. In this video, our focus is more on the concept, so you understand what is EPS, usage, calculations, and how to analyze, interpret, and limitation. So we will focus more on the conceptual aspect. In the calculation part, we will discuss in the next video along with few other elements of EPS. Yeah. So we'll discuss in detail how to calculate, but if there are issues or if there are buybacks during the year, so the equity share issued are being changed since the beginning till the end, then we have to calculate the weighted average number of equity share issued. Yeah. So if I just summarize quickly, EPS means earning per share. It means how much profit company is earning on one share. Okay. When we are talking about share, it means we are talking about equity share. So the simple formula is profit divided by share. Profit means earnings available for equity share, and share means number of equity share issued. So earnings available means PAT minus preference dividend, that will be your earnings for equity shareholders, and number of shares issued. Like if your equity share issued is changing during the year, then you need to take the weighted average number of shares. So that's how you will get EPS. Okay, so that is about EPS. Now we'll see what are the usage. So what's the purpose of this? Like what do people or companies generally use EPS for? So first is like very simple, profitability analysis. Okay, so if you see the EPS of a company, you will get to know immediately whether that company is profitable or not, right? Like if there is a company A, company B, or which company is more profitable or much better than other company, right? If the company A is having EPS as 10 and this is having 20, so you will quickly understand that from in one share, okay, I'll be getting 10 rupees here and 20 rupees here against one share. So looks like this company is maybe performing better. At least from this figure we can just quickly understand. Again I'm saying we cannot draw the complete conclusion, but on the superficial way we can say, okay, per share this is earning more, this is earning less. So for that profitability analysis purposes, this is useful. Second important thing is the valuation of shares. So to identify or to understand the stock's valuation, whether the share is overvalued or undervalued, right? This EPS is used. How? So using EPS, we calculate PE ratio, P like price to earning ratio, right? So from EPS, PE ratio is calculated, and when we analyze the PE ratio, we identify whether that stock is overvalued or undervalued. So if the PE ratio is higher, it means it's overvalued, and if PE ratio is lower than the industry or the peer, then it is undervalued. Okay. Don't worry, in detail we will discuss about the PE ratio. In the upcoming video we'll discuss what is PE ratio, how to calculate, how to analyze. But since this term has come, so I just want to explain that EPS is very important because it is used in the calculation of PE ratio. Using the PE ratio we do the share analysis, whether it's overvalued, undervalued, etc. So for valuation purposes this is used. Third is M&A, merger and acquisition. For merger and acquisition also EPS is very useful, because when you analyze a company you also want to see like what is my post merger EPS. So if I merge with another company, what would be my post merger EPS, so that we know whether the merger is creating the synergy or whether the merger is beneficial for the shareholder, whether it is increasing their earnings or not, right? If the after merger, post merger, like if EPS is not increasing, right, it means that merger is not useful for the shareholder, or their earning is coming down, right? So that's where this post merger EPS analysis is very useful. And then for investment purposes, like if you are an individual, right, who wants to invest in a company, so obviously you will go check what are different EPS, what are the different companies, what are their EPS, how much earnings I'll be getting if I invest one share in a company, how much earning I'm going to get. So that analysis is used when you do the investment, right? So these are basically the high level usage, profitability analysis, analyzing the valuation of a stock, or for merger and acquisition purposes to know the post merger EPS, and for the investment purposes, right? So these are things this EPS is used for. Now let's understand how do we analyze this EPS. So one thing actually you have to remember, and as I told in my previous videos also, while you do any financial analysis, you cannot draw the conclusion just from one figure or one ratio. You need to consider other element also, okay? And you cannot just draw the conclusion from 1 year figure, okay? You need to see the trend and everything, right? It's really important when you analyze a company's profitability or profit and loss statement. Think about all the aspects, check all the ratios and all the figures rather than drawing conclusion from one, right? So similar to that, when you analyze the EPS, so first is like when you're analyzing and comparing two different companies and all, you need to consider their industry and peers. So you need to compare against the industry and peers, okay? You cannot just, okay, you are taking one company in the software industry and another company in the manufacturing, trying to compare their profitability using the EPS. That may not be the right practice. And you need to consider, okay, if this company A is earning 10 EPS, okay, for example, then what other peers are doing, B, C, D, are they anything similar, or whether it's more or less, right? Then you need to analyze, okay? The second thing is trend. You need to see the EPS trend. You may see, okay, this year company has earned like 20 EPS, companies A's EPS is 20. And if you think, okay, looking at that, oh, this is a good company, let's say company B or peers are also having 18, 19, okay, and 17, then you may think, oh, company is better. But you also need to see the trend. What if the company A had the previous EPS as 28, 23, or like 25, 24, 23, then you will suddenly see, oh, there is a decline. Then you need to analyze, oh, why from 28 in 5 years the EPS has become 20. So again, you need to understand that year's figure, you need to see the trend, you need to compare with peers and industry to see how is it, okay? Then another important thing is the dilution impact. Let me explain this. Dilution impact. So what happens is, sometime in the balance sheet of a company there are some securities like preference shares or debentures. Those debenture or preference shares are convertible debenture, convertible preference share. When we say convertible, means those will be converted to equity share. So when their term is ending, okay, whenever the debenture term is ending, those will be converted to equity share. Whenever preference share term is ending, those will be converted to equity shares. Now when they gets converted to equity share, it will impact our EPS. How? Like for example, in this case, let's say our earning available for equity shareholder is 100,000 and the number of issued equity share is 1000. So our EPS is 100. Now let's say in the balance sheet of that company there are 1000 debenture, for example, okay, and those will be converted to the 1000 equity shares. If this debenture gets converted, right, what will happen is your denominator will change. So your now number of equity share will become 1000. But this will not change your profitability much because you are not getting any additional money. It's just the same debenture, you are just converting from debenture to equity. So it's not that you are getting additional money to increase your operation. Money would be same, it's just the conversion. So the denomination would change, okay, but the earnings mostly will remain the same. Not exactly, because earlier we might be paying them the interest, now we'll not pay them interest, okay, so that interest would be saved. So your earning will slightly increase, maybe from 100,000 it will become 110, right, because you have saved your interest, okay. So overall earning for equity shareholder will increase slightly, but it's not increased that proportionately, right? So overall what will happen, your EPS will go down. Earlier it was 100, it may be less now, it will be like 55 or something, right? So if you have a convertible debentures or convertible preference share in the balance sheet, and if they are getting converted this year or next year, then there is a very good chance that overall your EPS will go down. Okay, so you need to consider the dilution impact also. So for that purposes, there is something called diluted EPS which is being calculated. Okay, and this diluted EPS we are going to discuss in detail in the next video, where we discuss about the calculation. We'll also talk about the diluted EPS. Okay, so this also you need to while you analyze, you need to think about that or consider that also while analyzing. Okay, and also you need to consider the non-recurring income or expense. Sometimes what may happen is like for this company A, right? So their EPS was trend was 5, 7, 6, 5, and suddenly the EPS became 20 in 1 year. Okay, then you cannot just cannot think, oh, company has become very good, suddenly it is earning 20. You need to first understand the trend, and if it is a unexpected increase or an unexpected decrease, right, you need to go back, analyze the detailed profit and loss to see why it has increased. There may be a chance that there are like one-time profits have happened, okay, which is like non-recurring income or non-recurring profit. Those non-recurring profit or income is causing this sudden increase in the EPS, or it can be vice versa, that company EPS is going 20, 25, 24 and suddenly it drops to 5, right, in 1 year. So it may be there will be non-recurring expenses. Okay, so you need to analyze that, consider the impact of that also, that due to that the increase or decrease in EPS can happen, right? So this is again a thing that needs to be considered while doing the analysis also. Yeah, even for that, like there is something, a term called adjusted EPS. So that is calculated. This is basically this called basic EPS. Then we have something called diluted EPS to consider the impact of dilution. There is something called adjusted EPS to consider the impact of non-recurring income and expense, etc. So these are things like while you analyze, you need to consider this industry peer, you need to analyze the trend. Okay, you need to consider the dilution impact, you need to consider the impact of non-recurring income and expense. Yeah, so these are things, this is how you analyze, and these are things you need to consider while analysis. Now let's look at like what may be the limitation, what may be the limitation of for EPS. One is, okay, one of the limitation of EPS is does not consider, does not show or consider cash flow. Does not show, does not consider the impact of cash flow, because see, this EPS is derived using the earnings available from equity shareholder. Earnings are basically the profit. Profit comes from P&L. P&L is generating based on the accounting, right? All the accounting done, right? And accounting generally happens based on the accrual concept, right? Not on the cash concept. So since it derived based on the earning, so it consider only the accrued income, expenses, revenue on the accrual basis, right? So it does not consider how much cash inflows and outflows are happening, because there are instances or there are cases or there may be the cases where companies earning good profit, they are having good profitability, net profit or earnings or EPS, okay, but it may be facing the cash crunch, okay, because they may be selling the goods, their AR realization is not so good, right? So if the AR realization is not good, obviously they are not getting the enough cash for the turnover, right? So it does not show the cash flow because it works on the accrual basis based on the accounting, right? So you cannot predict what would be the cash flow. So there may be chance the profitability is good but cash flow not so good, so in the long term it may not be sustainable, right? Second this EPS is subject to manipulation sometime, or chances of manipulation, let's say. Chances of manipulation. Chances of manipulation, how? Again, this EPS is calculated based on earning. Earnings are calculated based on profit. Profit is coming from P&L, and which is coming from accounting practices. So there is always an element of what are our accounting policies and practices. So now in most of the cases our practices are generally same across the industry, but still there are cases where companies make their have their own accounting practices or policies, like how and when they would like to recognize revenue, or if there's a like capital asset, so how much depreciation they need to charge, what kind of depreciation method they need to adopt, right? If they are doing the R&D expenses, whether they want to charge those R&D expenses to the profit and loss statement, or it needs to be capitalized, right? So all these things sometimes depends on their accounting policies and practices, and sometimes company may like manipulate or change their accounting policies or practices, which may impact the overall earnings and EPS, right? The third example is buyback. The third limitation may be buyback impact. So sometime what company may do, let's say the company has 1,000 shares, okay, and 1,000 shares, so it had a like earnings was for 100,000 and 1,000 shares, so the EPS was 100. But let's say if company buys back 500, so if it buys back 500 shares, right, so earning would still be the same, but the denominator will change because now the shares are 500, so suddenly your EPS will jump to 200. Okay, so from 100 it became 200, but it doesn't mean, even if my EPS is increasing, it doesn't mean that my earning has become doubled. Okay, because it did not happen that way. It's just the shares were bought back, so your denominator changed and your EPS increased. So sometime, like if due to buyback, EPS may increase, but it doesn't mean the overall profitability has increased. It would still be the same. So buyback impact also needs to be considered. That is also like sometimes company uses that, right? And again, like the non-recurring item, although this we have already discussed, so there may be impact of non-recurring items in the EPS, right, which may present the wrong picture of the company if the EPS is inflated, right, or deflated also, like if the non-recurring expense has come. So these are some of the limitation. Main limitation are it does not show the cash flow, uh, how well company is doing in terms of cash flow, or there are always chances of manipulation because it is dependent on the accounting practices and the policies, and there's impact of buyback and etc., right? So these are the some of the limitations. So as I said, like while you analyze any company's financial statement, so not only one element you need to see, you need to see many elements, okay, and together, considering all the elements, you need to decide how well the company is doing, okay. But anyway, for this video, I hope you should be clear about what is EPS, what is formula, what are the usage of those EPS, and how do we analyze it, and what are things we need to consider: dilution impact, recurring impact, the cash flow, manipulation chances, and all, while you analyze the EPS. Okay, so I hope this video uh, would have been useful for you. If you think this video was good and if you learned from this video, please press the like button, subscribe, and if you want me to post any video related to financial management, you can write down in the comments, and I will take care of I will take up that video topic, and we will discuss in the upcoming video. But immediately next, I will post the video related to like how do we calculate the EPS, the calculations, also the diluted and adjusted EPS. All these things we will discuss. And thanks for watching, and please like and subscribe, and I will see you in the next video. Thank you.